Let's jump right into part 2. We left off part 1 looking at the COT report and with the idea that if the mining shares are showing us that gold and silver are getting ready to plunge, well, the large hedgers are not positioning in futures like they think it's going to. So one of those signals is wrong. Now this is the strip for silver futures. And right now we can see that the cash price for that's for immediate delivery silver is about the same price. In fact, it is the same price as the May futures contract, and really there's not very much contango between cash and July. Notice also that the cash immediate delivery silver price is still above the most distal contract for silver futures and several above it. So there's still a little bit of backwardation showing in the futures strip. My question is, if for example silver is getting ready to fall off the delivery truck, if it's about to plunge, shouldn't the strip be showing more contango? In other words, shouldn't silver be bidding for storage instead of having the cash price be exactly the same right now as the front contract? Right now the silver futures strip says that there's plenty of silver for current demand, but there's not an overabundance of it. If gold is about to plunge, shouldn't the really big money that holds part of that $68 billion hoard of GLD be racing for the theater door? But they're not, are they? And if silver is about to skydive without a parachute, shouldn't there be a signal there, like really smart big money who seem to see around corners and well ahead, getting the heck out of Dodge and selling their SLV big time? If they were selling big time, you can bet that metal holdings for SLV would be heading much lower, not more or less holding their own and moving sideways. We could show more of these kinds of indicators, but in essence what we're seeing right now is an outlier from the mining shares that are painting such a grim picture, but it's not answered by some of the or most of the other indicators that we look at. So as they say in the movies, let's cut to the chase, shall we? So yes, the mining shares are painting a grim picture, so much so that we have high profile trend jumper guys like Dennis Gartman finally noticing it, looking at a contemporary chart and telling us what we already know, that they have been in a downtrend, but then extrapolating and projecting that chart into the future to predict that the time for them is over. That is bullish, not bearish to vultures. We know that today's sell down, like the one in 2010 and the one in 2008, is a creature of very low, not high volume. It's a buyer's strike, not a wholesale exodus. That is bullish, not bearish to a contrarian vulture. This is the gold versus XAU chart or ratio. We know that the big miners relative to gold are now the cheapest they have ever been, and we encourage everyone to view this chart on the blog. Own this chart. It is a signal for contrarian fund and portfolio managers to sit up and take notice, just as some of the industry giants like Rick Rule and James Turk, Eric Sprott, Frank Holmes, John Hathaway, and quite a few other respected and trusted analysts, they've all commented that gold stocks have become inordinately cheap relative to the underlying metal. And one way you can look at this particular chart, you notice how gold has continued to go higher. It's consolidating up here, but gold stocks have sold off. This gigantic divergence between the two means that your gold that you've accumulated now buys more gold stocks than ever before. And so that's one of the reasons why I have, and I knew it intuitively before I saw the chart, but that's why I have decided to sell a little of my gold in order to put it to work in gold stocks, because I expect this ratio to contract. In other words, I expect the divergence to close in the near future. We know that the big hedgers are close to their lowest net short futures positioning for gold of the year. We know that the big hedgers are not aggressively selling silver futures. In fact, they're down near a quite low level historically speaking. And to us, that means that they're not positioning as though they think silver has a great deal of more downside from a $31 level. Let's move up just a little bit and we'll see the relative commercial net short positioning for silver futures is also down quite low. This is in what I consider bullish territory, and that is in a contrary sense, of course. If the large commercial net short positioning is not a very, very large portion of the overall open interest like it was here or here, instead we're down here, that just means that the hedgers are not aggressively selling futures of silver short. Indeed, it means they've got a small relatively small net short position for silver futures right now. If we look back over a longer period of time, it becomes pretty clear that it's kind of rare to have the commercial net short positioning down this low. That doesn't mean that silver futures are going to go higher tomorrow or the next 30 minutes, but what it does mean is that a lot of the selling pressure that might come into the market hasn't. The opposite side of that silver coin is that also means that there's not a great deal of speculative excitement in the market right this minute either. So while the mining share indexes are sending us breakdown signals like the Huey here, so much so that gold stocks as a group and as measured or by the XAU have never been cheaper relative to gold. With the small resource companies we like to game here at Got Gold Report having been unmercifully beaten up, it all means that mining shares have been telling us a grim story since September for the big boys and since last March for the little guys. Gold and silver could be headed lower if the mining shares are right. But if so, it'll be in contravention of so many of our other indicators. If gold and silver end up doing a waterfall plunge from here, it'll be in spite of the indicators we track and trust, not in harmony with them. And apparently, if they do plunge from here, it's going to be a complete surprise to the people whose job it is to hedge for things like that using futures on the COMEX. Now, because we already have reasonable positions in physical metal, we have the luxury of waiting for something to hit gold and silver and knock it down to where we think overwhelming support lives, which is down here in the green. I suppose we'd be more aggressive if we didn't have that physical metal. The same is true for gold. The last stop for this video is the gold-silver ratio chart, and for the last little while, or actually since October, it's gone pretty much sideways. And as you know, the market we're looking for is a falling gold-silver ratio, which is bullish for both metals. If the gold-silver ratio gets back up above 60 ounces to 1 ounce of gold, we're likely to make another trade to trade some gold for silver again. We believe the gold-silver ratio is going to return to its historic norm, or its historic mean, closer to 15 to 20 ounces of silver to 1 ounce of gold. So if you can trade, if I'm right, and you can trade gold for silver at 60 to 1, and then later on trade that silver back in for gold at 15 or 20 ounces to 1, you're doing pretty darn good. Do the math. You know, it's true that we vultures have been waiting to do that for quite some time, and we got pretty close in 2011 in April. You know, we got down to around 32 ounces to 1 ounce of gold, and so we did get fairly close to making that first trade. But one thing that vultures have to learn and have to possess, and that is a great deal of patience, because these things take time. But now just imagine how satisfying it will be if you have traded some of your gold for silver, as we have, at, well, 2 years ago at 70 ounces to 1 ounce, and just more recently at 56 ounces. Just imagine how satisfying it'll be when you're trading that silver in for gold at 15 ounces. So to sum up this offering, we think it's truly a bargain hunter's vulture paradise right now in the junior space, and we intend to take advantage when and where we can, understanding that no condition in the stock market lasts forever. We don't think the central banks are going back to selling gold anytime soon. We don't think that China's going to quit buying marginal gold in the world and stockpiling every ounce that they make in China. And I think that's going to keep a put under the price of gold for quite some time. Fundamentals are nothing but bullish. Negative real interest rates, exploding debt and deficit bombs in Europe and here in the States. There's declining confidence in government and in fiat currencies, and so on. We think it's time to be adding the small resource companies. We don't think they're going to be in the doghouse forever. Of course, everyone has to make up their own mind about such things. So that's it for this brief. Thanks for watching, and thank you very much for honoring us with your business. Bye for now.